Hi again folks, welcome back to Meaningful Money. I'm in the entrance of the Fogu thing at Cairn Uni, ancient settlement. So I know you can't really see anything other than that it's a tunnel, but I have to make a correction because as ever my research failed me on the last video when I said that this place was inhabited until about 500 years ago. Turns out I was only about 1100 years out. It was actually abandoned in the 4th century AD, so never mind, sorry about that. I promise you that the financial information is absolutely accurate. Okay, talk about gold. We talked about commodities last time. Gold is a subset of that, but it's a special one really, or at least it's got a special place in many people's hearts. Of course, gold has been around since the beginning of history, and it's been an important commodity since time immemorial. It's used obviously for coinage for millennia, and a very important part of how the financial system worked until really only, I mean, it's still an important part, but as far as currency is concerned, it's really only in the late 1800s when people began to tire of carrying gold around because of its weight and obviously its difficulty in separating it up into small bits. And it's really around about then that paper money really began to take off. And it actually took until 1971 for the connection between the gold price and currency prices around the world to be severed. In the post-Nixon era. So gold has just been around forever, and of course it's attractive, isn't it? It's shiny and yellow and lovely and precious. But it's now no longer anything to do with the currency we use. It's now a commodity and is bought and sold in its own right. Gold is measured usually in troy ounces, or sometimes in grams. But a troy ounce is about 31 grams, just a little bit over, and as of now the price of gold is $1,175 per troy ounce. That's about 750 quid per troy ounce, which is about that much if it's about that thin. So, you know, it's still incredibly precious metal. But the thing about gold is that it's finite. You know, there's only so much of it that has been dug up over the centuries. We don't know, obviously, how much is still under the ground, but in terms of its availability, it's finite, and that has an impact on supply and demand, which, as we've mentioned 2 or 3 times now, is an essential factor in the value of anything. So how can you buy gold for your portfolio? Well, you can buy actual physical gold, we call that bullion, and you can either buy that in bars, but I mean that'll cost you like a lot of money, or you can buy it in coins. The most famous of those is the Krugerrand, and the Krugerrand is about 1.1 troy ounces, so it's going to cost you $1,200 to buy a Krugerrand. Little anecdote, actually, I have a client who inherited some money recently, and the chap who died when they were searching out his house, which hadn't been done up, this house, for 90 years. It still had an outside toilet, but in his loft space they found 40 Krugerrands, which I make to be, what, about $50,000. See, that's mental arithmetic. It's probably wrong, but never mind. So you can buy Krugerrand, so that's buying physical gold. But like all these things, gold is very often bought in a fund. There's specialist funds for that, or it can just be part of a general commodities fund. Gold holds a special place, though, in economics generally and in investing because it's generally seen as a safe haven against 2 things. Firstly, against market volatility. So if everything else, all hell is breaking loose in the stock markets, or maybe the banks are close to collapsing, which is obviously quite fresh in our memories from a couple of years ago, then gold is somewhere that people run to get safety because it's physical, it's tangible, a little bit like property in that regard, but because it's shiny and it's been around for millennia, and it has an attraction against risk, but also it's a hedge against inflation. Now, inflation is the reduction in the buying power of money over time. So if your price of milk is more expensive next year than it is this year, that's inflation. And inflation can be a problem if it gets too high, but gold is seen to be a hedge against that, a safe bet against that. So that's why often people sort of run to gold in times of worries in the economy, as well as worries in the stock markets. So gold's like a subset of commodities, but essentially it's the same thing, supply and demand. The perhaps slight little twist in that is that sovereign states, except for us, hold gold. And that still happens in many places around the world, and that can affect supply and demand, but essentially that's what it comes down to. So that's gold. We've only got a couple more building blocks of our portfolios to go. The next time we're going to talk about hedge funds. So see you next time for that. Thanks for watching.